Howdy there, folks. Welcome into today's video. One video for me to react to and one video only. I want to react to this beginning segment of Fast Money from the other night. I thought this was really interesting. They had this lady on from BULLISH Securities who's the most bullish. She's been on the market in the past 10 years. 10 years, which is pretty shocking. And so she makes a bunch of different points here that I want to listen to, kind of share my perspectives on, let you guys listen to here, because I don't believe this clip is on YouTube. I record all the Fast Monies on Fubo, and then sometimes I'll watch them late at night and whatnot. And I thought some of her points were really good here. A few of the points were a little questionable. And so, yeah, I just want to dive into this. Hope you guys enjoyed as always. Thanks so much for being subscribed, folks. Another all-time high on subscribers. I mean, before you know it, we're going to be at 30,000 subscribers on this channel, so I appreciate each and every one of you for being here as always. Also, real quick here before we get into that, I know a lot of people in the private group have been, hitting six figures here recently and been submitting applications. I think we got 8 or 10 people in the queue. When I get back to Vegas, I'm going to ship them out, baby, okay? You guys are going to get your diamond awards. They're all at my Vegas house. I got 7-figure awards here at the Arizona house, but I don't have 6-figure awards. So they're coming for you guys. Check for them likely in the next few weeks here, okay? Alrighty, let's get into this.
Courtney Garcia, Dan Nathan, and our special guest tonight, Savita Subramanian from BofA Securities. And we begin with the rough start to the week for the markets. The major indices all down for a second straight session. The Dow falling 245 points, though closing off the lows of the day. The S&P and Nasdaq dipping less than 0.5%. The biggest sector laggard today, energy sliding more than 2%. Materials and utilities also closing lower. This after the major indices all hit multi-month highs last week. But even as the rally seems to be stalling, someone on this desk tonight is more bullish than they have been in at least a decade. And that person is our special guest tonight, Savita Subramanian. So why more bullish than you've been in a decade?
Well, I mean, I think the market is more rational than it's been in a decade, which is great news because we're, finally done with this sort of experiment of zero interest rates. We know what the Fed's going to do. We're off of a zero bound. We have 5 percentage points of latitude to ease our way out of the next recession. Real rates are no longer negative. I mean, I think that we're at a place where visibility and, kind of transparency of corporates is better than it was over the last 10 plus years. Now, in terms of
before she goes further, because she's going to rattle off point after point here over the next few minutes, okay? Before we go further, I think this needs to be addressed right off the front. There used to be a belief that if you had interest rates super low, that it's not going to be good for the stock market. The reason it's not going to be good for the stock market is that it means the economy is in a complete mess. If the economy is in a complete mess, that means earnings aren't going to be as strong. And there was a belief for a long time until we went through, obviously, 2008, 2009, coming out of that with the interest rates at near zero in terms of Fed funds rate, right? And the market does tremendous. And so now there's this belief that if you have interest rates that are, let's be honest, a Fed funds rate at 5% or so is pretty darn normal. If you have that, therefore, there's a thought process that, no, the market can't do good. We can't have the market go up. When in reality, if Fed funds rate's 5% plus, that likely means you're in a really strong, really good economy, which means you're usually going to have very good earnings coming, okay? And so I think that's like some food for thought there. These thought processes, they work until they don't. And then people are like, oh, yeah, that doesn't quite work the way I thought it was going to work. I mean, literally, if you went back 20, 30 years ago and you told people the Fed's going to have interest rates at zero, they'd say the market's going to do horrible, because it means if the Fed's going to have rates at zero, that means we're in like some sort of depression or some sort of massive recession or something like that. There was always a thought process, but it changed over the past 15 years. And now people think the market can't go up if you got a Fed funds rate of 5%, which is interesting.
Over the next 10 years, maybe they're a little bit lower than what we've enjoyed, but I think that they're driven by the right stuff: productivity, efficiency. Companies are doing all the right things right now, and I think it's kind of interesting to see corporate America adapt to this weird world that we've lived through. So that's why I think that we've got a lot more rational of a market setup today.
Some might point to, though, the rally in AI-related stocks and say that's not rational. That's sort of bubbly. And then we had Kava debut last week,
right,
and doubled in its first day of trading. I mean, it's a Mediterranean bold company.
So parts of the market.
Because one stock goes up doesn't mean you're in a bubble in the market. I tell you, okay. In terms of that Kava stock, people are probably just thinking it's the next Chipotle or something like that. So there's a lot of excitement there.
Still in a little bit of a bubble-like territory, but I think that where we are in terms of the broader economy is that the areas that have been starved of capital for the last 10 years are, all the problem children of 2008 and 2009, like big, banks, big banks, not small banks. When you look at energy companies, materials, industrials, these companies haven't done what they typically do in a booming economy, which is spend and create capacity. They have gotten very rational. Commodity companies have gotten supply discipline. I feel like we're at a place where old economy companies have learned how to survive without capital and actually look pretty interesting at these levels.
So, Savita, by the way...
That's a great point. And another point, and I've never made this point on the channel, and you're probably never going to hear somebody else make this point, I think it's very, very important if you're thinking about this market, is we have, in terms of the companies that drive the market, we've never been in a cycle where the companies at the top of the market have better balance sheets than they do right now. Never in history. Go back to the great financial crisis and look at what the biggest companies in the world were and look what their balance sheets look like. Go back to the tech bubble and look what the biggest companies in the world were and look at their balance sheets. Go back to 1987. Go to 1987, look at the biggest companies in the world, look at their balance sheets. Go throughout any time period in the past and you will find there's never been a situation where the top companies that really drive the market, which was really like 20 to 30 companies really drive this market up or down, have better balance sheets than today. They have far better, and it's not even close. And so that's a little food for thought, because a lot of times we're driven by a lot of these tech companies now. These tech companies just have ridiculous cash balances that, it's hard to even fathom. There's some companies out there that have more in cash and cash equivalents in short-term investments, long-term investments, than they do in total liabilities. And total liability is absolutely phenomenal. So that's just another, I guess you could say, level of comfort for the market.
Welcome to the desk, and a desk where we referenced the movie Stripes on the way in, by the way, Melissa. I'm sure
we did?
Yeah, we did. Fast cars and fast money, of course. But,
okay.
So the markets are more rational, or is it possibly that they're less irrational than they were? I mean, I would make an argument.
The right way to say
we
it,
were so irrational in terms of positioning, sentiment, and whatnot at the end of last year, and some of that's just all that. It's just some of the technicals of the market, positioning, sentiment, and we talk about that. That's part of the rhetoric.
Yeah.
But then I also hear you saying, really, when it gets to fundamentals, a lot of the people that think the AI stuff was irrational is it because it's not going to usher in this massive tech spend? Sounds like you think that it might, and it sounds like that's the real deal.
I think AI it's complicated, but it's not just a tech story, which is what's exciting about it, right? I mean, it's the idea that companies that have been clunky and haven't really fixed themselves in a long time have the opportunity to get leaner and lighter. I mean, I think what's interesting is that labor productivity just stalled out for the last 10 years because companies didn't have to really think about where they were going to generate earnings from. They had free capital. They could just buy back their stocks. So they had this kind of low-hanging fruit of low-quality earnings growth. And I think today what we're seeing is AI is just part of this whole efficiency automation.
That's a flippin' flapjacking good point she just brought out there. Absolutely phenomenal point. Absolutely phenomenal point. I mean, at the end of the day, companies have, especially over this past year, have really focused on getting a lot healthier, getting leaner with their workforces, right? And trying to find cost synergies in their businesses that they just weren't looking for before, right? The drop in the market last year forced every single public company, especially a lot of the biggest big dogs that really run this market, to focus up. And you could start at companies like Meta. You can start at companies like Amazon and look at the layoffs those companies have done. Look at how much they've leaned out their organizations. And the main reason they did that is honestly the market forced them to do that. Taking Meta stock under $100 was shocking. It's one of the most shocking things I've seen in 15 years being in the stock market. Seeing Meta go under $100 a share. That was Wall Street basically forcing Meta to say, you guys better lean up. You got to get this company right. You got to get back to major profitability. And Zuckerberg did that. And the brilliant thing is Facebook in Meta is going to be far better run over the next few years than it has been over the past many years, because they're going to have a far more leaned out, streamlined organization, probably the most streamlined organization they've had since shortly after they went public, which is saying a lot. And so what you're going to see is Meta's earnings go through the roof. And I wouldn't be surprised if you actually see better revenue growth over the next several years than you've seen over the last couple of years here, okay? And so, yeah, she makes just a phenomenal point there. And now it's not just, oh, we're going to buy back our shares and that's how we're going to get our EPS to go up because we have less shares outstanding to count against our net income. No, okay, now they're taking it to other steps that are going to make these companies far healthier and far more profitable.
Doing more with less theme that I think is going to be really bullish for corporate margins. So the question is, what's worse, getting off of globalization, which we seem to be doing, paying a higher cost of capital, but also kind of writing our business models and really thinking about permanent productivity growth. And what we found...
Yeah, and I don't know, there's a lot of people saying, oh, we're getting off globalization and globalization's dead. Basically meaning, American companies being able to get a lot of earnings from China and other markets. I'm not so convinced of that. I think we're just trying to get less reliant on China. And I think what I'm seeing out there is a lot of big U.S. companies are starting to be very focused on India. India is a massive opportunity, massive opportunity. I'm very bullish on India over the next 20, 30, 40 years. Very excited about what India is going to have going. And I can tell you that's going to be a massive growth market as, India has a population of well over 1 billion people, right? As more and more folks in India reach the middle class and, get wealthy, because that's what happens when you have that wealth effect, right? It's going to mean great things for a lot of these American corporations. And so I think that's the big thing because we've just been so reliant on China, Taiwan, right? This house in Arizona is only, 10 minutes away or so from TSMC, okay? The new massive TSMC factory that they're building here in Arizona, right? And I went by that thing the other day. I drove by it on the 303, and it was phenomenal to see that. Like a structure like that being built. And what that does for America. We've never had a facility like that in the United States of America. And I wouldn't be surprised if the government ends up forcing, this is something you hear here first, okay? I wouldn't be surprised at all if the government forces all super high-end AI chips to be made from that particular facility over time. The reason being is I don't think they're going to want those particular chips made in Taiwan anymore. I think Taiwan's going to continue to be a big player for us overall, but I think a lot of the highest end chips are going to actually be made here in Arizona. That's my personal belief on that. Seeing the government's moves, in understanding, what the China-Taiwan relationship there and what could happen or what might not happen, I wouldn't be surprised if the U.S. says, it's some sort of situation where they don't want these chips made anywhere other than the United States moving forward for those particular chips. And so, I think that's the main thing about this whole, is it deglobalization? I don't think so. I think the U.S. and Europe are going to continue to be friends. I think U.S. and China are going to continue to get along decent. I think just understanding the ramifications and understanding, we also got to help build up India. India could be a massive, epic market over time. Why just focus on helping build up China? Because a lot of people have the opinion that the U.S., we built up China. And I would say we both helped out each other. I would say probably China, we got helped out more than we got helped out. But nonetheless, if we weren't there for China to help them grow, then I can tell you our companies would have a lot less earnings. All these companies get a lot of their earnings. I'm part of stocks that get significant amounts of their revenue and profits from China. Obviously, if we speak about Wynn Resorts, Macau's always been an insanely, big market for Wynn. It's the biggest market usually over time, except for obviously coming out of Rona here. But Macau's always been way bigger than the Vegas business for Wynn. If I think about Tesla's getting ridiculous amounts of their net income now and their revenue from China. And so, I'm a beneficiary of that. And that's why I think our relationship needs to continue to grow and continue to be there. I just don't think we want to be as reliant on China. And especially when you got this other emerging market that is going to be absolutely massive. Could India be bigger than the Chinese economy someday? I don't know. Maybe. If it is, it's not going to be for quite some time. But, India is just a crazy big opportunity long term here, folks. And so really, really excited about that. And I'm also really, really excited for the way a lot of my companies are positioned in India, including Meta.
In our quant work is that the market assigns a higher multiple to companies that are focused on efficiency and productivity rather than just cost cutting and kind of financial engineering. So I think that's exciting. That's why I'm bullish. Again, I think there are parts of the market that are irrational, but I'm no tech analyst, and our tech analyst believes this AI theme is strong. It's a long-tailed theme. Companies are going to have to spend on AI just to stay alive. Tech companies are going to spend on AI. Old economy companies are going to spend on AI. Everybody is. So it's not just, a one theme market, but I think the productivity gains are really what I'm more excited about.
Savita, you just mentioned some of these old economy stocks that have learned actually how to maybe manage their businesses better. But I look at one chart. I look at the Fed's balance sheet over the last 4 years,
Yes.
and I look at it going from 4 trillion to 9 trillion. Now it's back at 8.4. And I wonder how well they.
And the other thing I'll say is, I think from the U.S. standpoint, beyond just tech companies, I think the U.S. wants to get in really good with India. And I mean really, really close relationship. And I think one of the reasons is, I think they see what obviously China is doing in Africa, and, how much China is really going to have, in my opinion, like a position of power in Africa, just in general, over this next, many decades, based upon a lot of the loans the Chinese government's doing, a lot of the infrastructure projects and things like that. And so I think the U.S. sees that, and I think they're like, let's make sure we get in really strong with India specifically, because India and China have always had, they've gotten along, but they also, I don't know, the relationship to me has never seemed like that great. Let's just put it that way. It's never seemed that outstanding. So I think the U.S. sees an opportunity here to be like, let's make sure we're like this with India over this next, 20, 30 years.
Actually had to manage when you consider just how much accommodation, both fiscal and monetary, that has existed over the last few years. And I feel like some of this could be a mirage, and this AI story might have come at the perfect sort of time, if you think about it, when we were seeing data that is slowing for the broader economy. We're clearly seeing it across.
This is funny that this guy, Dan Nathan, has to sit next to her, because he's always so flipping flapjack and bearish, and to have to listen to this lady that's the most bullish she's been in 10 years, just like, he must just be like, oh, it's delusional, this is ridiculous.
Globe, Europe right now, and obviously in China.
Yeah, so data's slowing, and I think we are in a credit cycle. I totally agree with you. I worry about the companies that have been inflated by Fed balance sheets. But what's interesting is when you look at the companies that have seen the largest multiple expansion from just the Fed buying everything, those are growth stocks. Those are tech. Those are, smaller, growthier companies with longer duration that need capital to survive. But most of the S&P 500 is actually generating free cash flow. I mean, what I worry about are maybe the zombie companies that have been kept afloat by just free money. But I don't think those are as acute within the S&P 500.
Exactly.
And then when you look at the real long-duration companies like, communication services, new media, they're actually doing the right things. They're cutting costs. They're returning cash to shareholders through big buybacks. They're basically shortening their duration risk. Like, if you think about this as a bond investor, what these companies that had great growth way out in the future are doing is they're giving you a coupon right now.
But my point is more that we've alchemied out a recession, right? So everyone was convinced at 3,600 in the S&P last October that we were going to have a recession in 2023. But all of this liquidity has put that off, and it's given a lot of companies that might not be
talking about yourself, Dan,
at the valuations where they are, at not, they're doing just fine, I guess, is part of the point.
Potentially. I mean, here's my view, and I mean, nobody agrees with me on this, but
we'll see. Hold on. Give us a chance.
Well, I think that real rates are actually going to move higher from where they are now. And what's interesting is that when real rates move higher, the equity risk premium almost always moves lower. So you actually want to be in stocks, and you want to be in high beta stocks in an environment where real rates are moving higher.
Can you explain that? Because on some level, when I think higher real rates, I think it on some level makes the value of equity investing and reaching out the risk curve less valuable.
Right, right. But when you look at actually the cost of capital for equities over time, what's really remarkable and what I was surprised by is that the cost of equity stays relatively stable, and there's this trade-off between real rates and the equity risk premium. So what happened last year, right? It felt like a horrible market, but actually high beta stocks did really well, and the low beta or the growthier areas of the market derated. So that's why I think it gets...
Savita, you've made a lot of good points, but what in the flipping flapjacking world did you just say? Did you just say high beta did well last year? What?
Relatively stable, and there's this trade-off between real rates and the equity risk premium. So what happened last year, right? It felt like a horrible market, but actually high beta stocks did really well, and the low...
Were you not in the stock market last year, Savita? I'm a little confused. No. That's just not factual. That's just not factual. High beta stocks got trashed last year. I don't know where she's going with that one, but no, okay? You made some good points, Savita. That was not one of them.
Or the growthier areas of the market derated. So that's why I think it gets interesting, is that we're all ascribing this, this value to defensives and quality because we're going into a recession. But meanwhile, what's actually really cheap and disciplined, and it has the potential to return capital, are cyclicals that have basically gotten very lean and have supply discipline. It's a very weird argument, but what we found, and I think this is where the quant work helps, because we've really found this very strong relationship between equity risk premia and real rates. And I think the reason real rates move higher is actually bullish, which is productivity. And we've seen this time and time again. Whenever we get productivity gains in the economy, we see real rates move higher. So it's kind of a good story. It's not all bad out there.
So you're the most bullish you've been in 10 years. Well, your target's 4,300 grand.
So I think there have been better points at which to enter the market. And, back in 2011, we were really bullish because the market was so dirt cheap. Today, it's not as cheap. But I think that there are parts of the S&P 500 that look incredibly attractive. And the underlying, like the thing that's obscured by mega caps is if you take out the 50 biggest stocks, the PE of the S&P 500 x 50 is 15 times trailing earnings, which is actually relatively low. So I think that there are value opportunities, but they're right now being obscured by this sort of AI bubble.
So the real call here, because we're above your year-end price target.
We are. It's hard to...
Another one throwing out that AI bubble thing, and they just love to say AI bubble. Like, what are you talking about here? How do you know it's a bubble? Like, you know what I mean? It's frustrating, man. It's frustrating. It's a little frustrating because no one knows if it's a bubble or not. To just say it's a bubble when a company like NVIDIA just goes from saying we're going to grow, or analysts thinking they're going to grow 6% to now they're saying they're going to grow revenue 60%. I think it's hard to throw a bubble out there just because a stock's gone up a lot. When you're expected to do all of a sudden 10 times your revenue growth rate, which means you're likely to do way more than 10 times your net income that was expected. Like, I think there should be some things maybe considered that maybe that stock does deserve to go up a massive amount, right? And so, I don't know. We'll see with a lot of these other companies, what they report, especially, companies like Palantir. But if these companies come through with some epic numbers over this next few quarters, I think it's going to be harder and harder to just say, well, it's just some bubble or something like that. So we'll see.
Up with this
exactly.
market.
When you raised it, I think you were above your price target at that point in time, which had been 4.
And because there's such consensus and all these people just throw out AI bubble, it makes me feel like I should buy some calls on Palantir or something. Okay, that's all I know, because I'm like, it's such consensus to just say AI bubble. And I'm just like, when everybody's so convinced of something, it's usually the other way. When bubbles actually usually form, there's not this overall consensus of everybody just calling it a bubble. I think people are just quick to call it that because of what happened in 2022, what happened with crypto, what happened with growth stocks, and all the rest of the whole story, right? So interesting.
1,000 or you were
we raised it before it cleared our target, but we had like a week.
Exactly.
Yes.
It's hard to catch up with this market.
Yes.
But the real call here seems to be going to, if you had to choose between, say, S&P versus RSP, equal weight S&P, that the choice would be equal weight S&P.
Equal weight, absolutely. I think the market just broadens out from here. I think what we're seeing right now is, it's not necessarily a bubble in tech. Some tech companies are going to do great. Other tech companies aren't. But I think where we are now is actually a pretty good setup for the overall economy. Think about it. We've been waiting for this recession for 6 quarters now, ever since the beginning of last year. Clients have been getting more and more bearish and more positioned for this impending recession. Our economists are forecasting a recession 2 quarters out with a peak to trough decline of 0.8% GDP.
No biggie.
That's no biggie.
Whatever.
That's like kind of a nothing recession. It's like a soft, shallow recession. We're seeing negative earnings growth, but I think this year we could see maybe minus 5% earnings growth. As long as demand holds up, consumers and corporates have a ton of money that the government and the Fed gave us. So, I feel like things aren't as bad as one might be.
I put zero Like Robert De Niro, who just had a baby at like 83 years old. Zero faith in any of these economists in their projections and their numbers. And, oh, yeah, we think there's going to be a recession, but it's going to be like 0.8%, 0.5%. Baloney, okay? Baloney. There's a reason Warren Buffett says, don't trust economists, okay? Don't trust these folks. Because at the end of the day, like, they throw out these projections and things like that. Especially if you're actually having a recession, if you're starting to see job losses, like the dominoes can fall quickly in that situation, as we saw in obviously 08, 09, where the dominoes, and they fell fast. And so if you're of the belief that there's going to be a recession, if you're of the belief that unemployment's going to climb, it's hard to predict that here's where it stops. You don't know when it stops. Like that baby can keep kind of running for a bit. And so, don't get too hyped or up or down on these economists and their projections.
And I could not agree with this more. This is really what we've been saying really all year.
That's so nice to hear.
Yeah, right.
She even said no one's going to agree with me. So here we go.
But we do find that with a lot of our clients where they come to.
By the way, shout out to this lady, this Courtney Garcia lady. She's like super pregnant, okay? I'm telling you, she's like super pregnant and she's still doing the show. Respect to her, man. I'm afraid one day she's going to have the baby on the set or something. It's getting crazy.
And they're overweight the S&P, they're overweight these tech companies. But I think what a lot of people don't realize is how, yes, the markets have been doing fantastic this year. Yes, they're into new bull market territory, But yeah, take out just those top couple of stocks, and the rest of the S&P is really just getting started right now. I think that's what people have to realize. Really, you haven't missed out on the rally. It's just now broadening. And I think, to your point, there's a lot of areas right now that are really great value. And I think you say this perfectly.
So when you say you want to be in high beta stocks.
By the way, let's discuss this before we go further. Why does the market do that? Why would people position into, the Apples and the Teslas and the Nvidias and obviously there's certain stories going on with a stock like Nvidia, right? And Google and Amazon and the biggest companies, and then from there start to invest, kind of outward into some of the smaller companies and things like that. The reason something like that happens is if you're going to start dipping your toe back in the market, and let's say you're starting to go a little more bullish, you're usually going to start with some of the biggest of the big dog companies in terms of starting to put money in those, okay? That way you feel a little more safe because you understand risk out there, but you look at those companies' balance sheets, their business models are so highly relevant. You look at their profitability, and you're like, you know what? I feel comfortable investing in these. And then as you get more comfortable, then you start working into some of the other large cap stocks. Then you start working more into some of the mid cap stocks and the small caps, and you kind of work your way down. And as the market goes and goes and goes, and people turn more and more bullish, what you start to see is the last phase of a bull market is usually when even the worst stocks in the entire stock market are getting bid up, okay? That could be, penny stocks, to be honest. It can be, wild situations like obviously what we saw with the AMC and the GameStop and all that stuff, okay? That's the very tail end of a bull cycle, when those ones are even getting a bid, essentially, okay? And so it's a process to get there. It doesn't happen overnight. And that's kind of where we're at with the market right now. And that's why you've seen the indexes fly. And so you could actually see a scenario where, let's say the market's kind of bullish for the next, let's say year, the next 12 months. You would see a situation where the indexes maybe don't do that much. They perform decent, but they don't go up that much. But you actually see a lot of the other large caps, right? Which, when I'm saying these type of large caps, I'm really speaking about under $50 billion market caps, but over like 10 billion, where you start to see some momentum come in those, and a lot of momentum come into a lot of the mid caps and small caps, where some of those stocks are maybe going up 30%, 50%, 100% if you're in a bull cycle. But you're not seeing the indexes move up even remotely close to that. Maybe the indexes are up 5 or 10% because money's going into smaller plays that don't move the indexes up that much, okay? And so that's just something that you could potentially see out there, and that's why the market moves that way, and that's why the market works the way it does.
When typically you think of high beta stocks,
and
you
it
think
makes
of
logical sense. It makes common sense.
Here you're really talking about beta that will exist in other sectors. Is that what the message?
Right,
yeah,
absolutely. So, what's interesting is that tech used to be high beta, and now it has dropped in beta.
Yeah.
It's now considered kind of defensive, like software companies are defensive. I don't know about that.
It depends. Maybe companies like Apple, Microsoft, some of those big dogs are seen as maybe a little defensive, a little more safety. But I mean, there's still a lot of in obviously big tech that is not seen as, last year showed us a perfect example. People do not look at Nvidia as defensive. People do not look at AMD as defensive. People do not look at Meta as defensive, although they are going to in the future years. People do not look at Amazon as defensive, right? All those stocks I just rattled off there, they all fell 50% to 70% last year. People do not look at Shopify as defensive. So, no, do keep in mind, this is very, very important, okay? Keep this in mind. Even back in 2018, Apple was not seen as defensive. There was really a risk on, risk off type stock. And, if everybody wanted to take risks, you got into Apple. But as soon as people didn't want to take risks, it sold off hard. And you saw Apple stock sell off like a beast in late 2018, like an animal. That stock, no one wanted a piece of Apple. But back then, Apple was seen as more of a risky stock. Fast forward 5 years plus later, and Apple is seen as not risky. It is seen as safety play because their services business is so built out now. And a lot of people just look at their business model as like, people are going to buy another iPhone, and if their iPad breaks, they're going to buy another one, and their MacBook breaks, they're going to buy another one. So there's a very different view of Apple than there was 5-6 years ago, okay? Now, that's going to happen to other companies. There's going to be a day when obviously a company like Meta is going to be seen as a safety stock. And when a company like Amazon is going to be seen as a safety stock. We're not quite there, but I say within the next 5 years, 100% you'll be there. The next massive major market drop, those companies will be seen as safety. And people will be talking about, this is where you need to plow money over here because this is where safety is. So, that's just what happens over time with companies as they mature. And people understand their business models more, and they understand they still got earnings power even in bad times.
Maybe they're not. Maybe, software companies are going to have to spend a bunch of money on chips and AI in order to remain competitive and remain alive. I think what might be more high beta today are energy, materials. I actually think today morning the housing starts number was a sign that we could be in for a pretty good period for commodities, lumber, metals, et cetera. It's not just about China. It's also about what's happening here in the U.S. And we've underbuilt single-family homes. We've underspent on, manufacturing capacity. And those are themes that we're starting to see companies really break ground on.
Here's a question I really want to ask, and that is, as a strategist, you start out and you have to put out this year-end forecast, 14 months before the next year ends,
Indeed.
Which is really hard. And so, when you put that initial target out, you thought there was going to be a recession. I'm just wondering, at what point do you say, you know what, it's time for me to completely rethink the thesis? And what was that sort of light bulb moment?
What was that moment?
Was it just that the markets were shooting higher and you're like, I can't miss out on this? Or
it was, I don't think, it wasn't just momentum. I think it was the idea, even at the beginning of the year, we were looking at sentiment measures and positioning. And it was like the most consensus call was, be out of stocks in the first half and then buy them in the second half. And that was what everybody was saying. And, so we looked at this and we thought, okay, the risk is that it does the exact opposite. And here we are at the beginning of the second half.
It was so flippin' flapjack and true because that was the belief. And as somebody that watches a lot of CNBC each week and sees these Wall Streeters go on and give their opinions, and these analysts and these fund managers and everybody, I can tell you she's 100% on. The belief was, if we go back, back in time to December 2022, January 2023, let's go back 6 months ago or so, I'm telling you, everybody was like, don't be in stocks the first half of the year. Buy them in the second half of this year. Which also makes me think, could we dump in the second half of the year? That's what I start considering. I'm like, wait a minute. So we did the opposite here. I don't know. We'll see what happens here, but I wouldn't be surprised, knowing how wrong the market usually is. Oh, gosh, man. Very interesting.
There could be some downside risk in the overall index, but I think what you want to do is stay long the equal weighted index.
Well, lucky for us, Savita's sticking around, so we'll have much more of this conversation come.
Sweet. So that was quite a beast there. I thought Savita made some good points. I thought she made some questionable points, and good to watch a video like that. A lot of times we watch some of the doomsday videos on why the market's going to crash and things like that. And I just love hearing a different perspective, which is why she's the most bullish on stocks she's been in 10 years. So appreciate you guys joining me as always. Thanks so much, folks. Thanks for being subscribed. If you're looking to apply for my private group and learn everything I got up here that I've learned over the past 15 years, and you want to scale your portfolio and all that good stuff, check out it'll be the pinned comment down there. If you're looking to join my Patreon and you get access to the moves I'm making in the market, which I'm making moves tomorrow in that portfolio, the stocks I'm buying and selling and whatnot, then you can check out the description area. That's to join us in the Patreon. Much love as always. Appreciate you guys. Thanks for being here. New all-time high subscribers, and have a great day.